collapse in the oil price has put the brakes on lots of deals, but there are still assets for sale, and there are still oil companies that continue to look at deals to rebalance their portfolios, add value to existing businesses, and capture opportunities. But when the oil price is fluctuating, it can be very challenging for buyers and sellers to agree on asset valuations. This is sometimes called the bid-ask spread. One way to bridge the price expectation gap between buyers and sellers is for part of the purchase price to be deferred and made contingent on oil price stabilization and recovery. Key points for buyers and sellers to negotiate are: firstly, what proportion of total price is to be made contingent, and when is it payable? Contingent price kickers can be triggered on things like the discovery of further oil and gas reserves, production profiles over time, other project milestones, as well as oil price movements. Secondly, is there a total cap on payments, and is there a sunset clause? Sellers will want to seek to maximize the speed and quantum of payments, while buyers will seek to cap their exposure and set a date at which point payment obligations end. Is the buyer sufficiently creditworthy to pay when amounts fall due, and will the seller take security for payments? Depending on the size of the contingent payments and the length of the payment horizon, sellers may want payment guarantees, letters of credit, or cash collateral to stand behind the buyer's payment obligations. The tax and accounting treatment of contingent payments will need to be analysed in the relevant jurisdiction. Finally, are there any limitations on the buyer's liability to pay contingent amounts? For example, what happens if the seller has breached the contract or there is an indemnity or warranty claim against the seller? Buyers will want to set off payments against claims, while sellers may want those matters to be dealt with independently. Beyond pricing structures, we're also seeing innovative financing solutions to help get deals done. For example, there are sellers who are willing to provide financing directly to buyers. We're also seeing asset swaps and sellers agreeing to retain or contribute to some of the long-term liabilities of the target business, such as decommissioning costs.